Thank you for watching this video. Today we will be doing technical analysis on the stock market for the week ending Friday, December 4th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. This week, the S&P 500 was up 1.67%, and we closed at 3699.12 for the week, making this another all-time weekly closing high on the S&P 500. This first chart that we're going to look at is an 18-month weekly candlestick chart of the S&P 500. So each candlestick does represent 1 week of trading on this chart. The blue line is set at 3,600, and so what we can see here is over the last 2 weeks, we have closed above 3,600. This market is just on fire. It just doesn't seem to want to stop going up. And I think you're going to see through the course of the charts I have to share with you today that it was a pretty bullish week in the stock market. You know, the question becomes, have we ran too far too fast? We're getting quite a bit of distance between where we're trading and the 40-week moving average on virtually everything. And of course, the green line here is the 40-week moving average on the S&P 500. And just eyeballing this, guys, you can see that that is a long ways away from the 40-week moving average. So just something to kind of keep in mind and keep your eye on. But as long as we continue to close above 3,600 on the S&P 500, there's probably not a lot to worry about. The next chart that we're going to look at is for the NASDAQ 100, more specifically the Triple Q ETF that tracks the NASDAQ 100, and this is also an 18-month weekly candlestick chart for the Triple Qs. The blue line is set at 300, and you can see here that we set a new all-time weekly closing high in the Triple Qs, up 2.20%, and closed at 305.60 on the Triple Qs, and you can clearly see that this was the first time that we have had a weekly close above 300 on the Triple Qs. So the NASDAQ 100, just like pretty much everything else this week, went up after consolidating really for about 3 months in kind of some sideways choppy trading, but broke out this week, up 2.20% for the week, and again closed at a new all-time weekly closing high with the first ever close above 300 on the Triple Qs. The next chart that we're going to look at is for the IWM. The IWM is the ETF that tracks the Russell 2000 Small Cap Index here in the United States. The Russell 2000 ETF was up 2.05% this week, and we closed at another all-time weekly closing high on the IWM. This particular chart goes back 3.5 years, and the reason I wanted to go back this far on this, and by the way, each candlestick is also a week on this chart. The reason I wanted to go back clear into 2017 is to show you how we really were just trading sideways with, of course, a lot of volatility in the IWM, the Russell 2000 Index, for almost 3 years, from the level we hit right here in December of 2017. If you can see where my cursor is moving, go to the right here, and you can see clear in September of 2020, we were still trading at that same level. The highest level we had ever hit in the IWM, the Russell 2000 ETF, was back in August of 2018. Came up and flirted with that area in January of this year, but couldn't quite get above that, of course, before the coronavirus sell-off. Well, finally, this last month, right, so for 4 weeks in a row now, we've been making new all-time highs in the IWM. So finally, last month, we got above the all-time closing high from over 2 years ago, and we've been making new all-time highs 4 straight weeks in a row in the Russell 2000 Small Cap ETF, the IWM. So as long as small caps continue to advance and pull the overall market with it, the market will probably continue to go up. But keep in mind that the market has come a long way in a very short period of time, and at some point we are going to experience some type of a pullback. The next chart that we're going to look at is for the Wilshire 5000, and the Wilshire 5000 was up 1.70% this week, and again closed at a new all-time closing high on the Wilshire 5000, closing at 38,703 0.02. Now, the Wilshire 5000, for those of you that aren't familiar with this index, is the broadest index in the United States. Once upon a time, it had 5,000 names in it when they first created it. Right now, because of mergers, acquisitions, fewer IPOs, companies being delisted, going out of business, whatever, there's less than 4,000 stocks currently in the Wilshire 5000. But they don't change the name, right? So back in the late 90s, there was over 7,200 names in the Wilshire 5000. Right now, there's less than 4,000. But just keep in mind, the reason this is important, the reason it's important to look at this index is because it gives us a snapshot of the entire U.S. stock market, because this is basically every stock in the U.S. that has enough volume, enough trading volume to qualify for inclusion in the Wilshire 5000. So with that said, let's take a look at this. So this is a 5-year weekly candlestick chart of the Wilshire 5000. The trend line I drew over the tops of the peaks in the Wilshire 5000 over the last, well, really starting in 2018. Okay, so you can see here, and you can see what normally happens. We come up, hit this line, pull back to the 40-week, equivalent to the 200-day moving average. And you can see it happened here, of course, and then we fell below it because of coronavirus. We came back up, and we were bumping our head, so to speak, on the top of this trend line, this overhead trend line, up until this last month. Okay, so for 4 straight weeks, as you can see right here where my cursor is moving, we have been above this overhead trend line. So the question becomes, have we shifted into a new higher gear in the overall stock market where we're going to continue to have expanding multiples, and the market is looking so far forward, beyond vaccines and treatments, and all of us getting back to being able to go out to restaurants and travel, do whatever, get on airplanes? Is that what's allowing this market to continue to run at this pace? And maybe it doesn't matter, right? Maybe it doesn't matter that we're now trading well above this long-term overhead trend line. So that is one possibility. We'll just have to keep an eye on that, right? We just have to watch. I mean, does the S&P 500 stay above 3,600? Do the triple Qs stay above 300? Does the IWM continue to make new weekly highs and stay above its previous all-time high back in August of 2018? We're just going to have to keep an eye on this, guys. With all the stimulus and super low interest rates, there is a case to be made for the market continuing to go higher from here, with higher than historically normal PE ratios being permissible, if you will, in this environment. However, we are pretty stretched on the Wilshire 5000. We're trading almost 20% above the 40-week moving average on the Wilshire 5000 right now. And keep in mind that a bear market on anything is when that equity falls at least 20% or more below its previous all-time high. The reason I point that out is if the market stopped going up right now and the Wilshire 5000 pulled back to its 40-week moving average, that would be almost a bear market without going below the 40-week moving average. So it just shows you how far above that long-term trend line that the Wilshire 5000 is currently trading. So just kind of keep that in mind, guys, that, things are going pretty well right now, and the market has a lot going for it, no doubt about it, okay? Low interest rates, stimulus, the reopening trade, but, there's always risk in the stock market, and we cannot continue to go up at this pace forever. It's virtually impossible. At some point, we're going to get some type of a pullback, so just be prepared for it. And with that said, I want to invite you to take a more serious look at Simple Market Signals, guys. Simple Market Signals is my personal risk management system. It took me over 20 years to figure this thing out. It works in both up and down markets, so it'll help keep you in the market when the market is favorable to equity investments, right, by following the signals. Conversely, it acts like risk radar, right? So when risk is low, as I say, stocks can grow. When risk is high, stocks will die. So if you'd like to know more about this, if you'd like to get a real handle on your equity investments and know when the market is most favorable to equity investing, and also when the market is least favorable for equity investments, please pay close attention to the rest of this video. Do you have a stock market risk management system? something that helps you understand the various risk levels in the stock market on an ongoing basis. Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over and that things were changing. And so I gave people a heads up right here over the weekend. And I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the simple market signals model, there are three powerful indicators. There's the simple market signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an emailed newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file, all right? So once you subscribe, you go out to the website, simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy, and you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information, and you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend, all right? So the goal is to get it out Saturdays by 2 p.m., but it could be any time over the weekend depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday, all right? And then once you subscribe, we will send you, as soon as we can, the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders, because it's probably hidden in there, all right? So you should get the automatic welcome letter and then the latest edition within the next day or two of your subscription. And then again, the standard newsletter goes out every weekend, but we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.